Hello, South Florida. Welcome to another live edition of the Real Estate Show, South Florida's #1 program about real estate and America's longest running daily radio show. Heard here live Monday through Friday. That's 5 days a week at 5 p.m. in the evening, coming at you 5 different ways on the AM, on the FM, through the apps, through the website, and on Facebook Live. 5 different ways to continue the show, and hopefully you'll bookmark it, join us, and make this a regular stop. Get your daily dose. We talk about everyone getting a triple dose. I'm talking about getting a 5 times dose every day, Monday through Friday. And then don't forget to get your mega dose of real estate, our summary, our repeat back to back of all of our shows that are recorded on Sunday night at 9 p.m. So we have this whole week. Number one, reminder that night at 7:30 is our first time home buyers workshop. This is going to prove to be very interesting, very informative. If anyone wants to still attend by webinar today, you can text the letters DPA for down payment assistance and all of the other benefits we're going to be talking about on tonight's webinar. Just text it to 561-861-2366. That's our dedicated real estate show smart text line. You can text the letters DPA. You can do it right now, and you'll get an automatic response. And shortly after that, you'll get the link to the workshop tonight. Absolutely free, nothing being sold. It's entirely educational, entirely to benefit those who want to make a little piece of the American dream theirs. And it goes in line with our mission to educate, enable, and empower more people to own real estate here in America. I think real estate is one of the pillars of our economy. The more owner-occupied properties that we have, the better. The better the landlords that we have, the better. And certainly, we don't want to put that in the hands of the government, who has proven that that's not their strength. So we've been talking also about that situation with first-time home buyers. I mean, yesterday on our Mondays on a Mission, we talked about the question is, who's outbidding you by tens of thousands of dollars for that home of your dreams? And the answer, really, according to our conversation yesterday, was the hedge funds out there. So we had a conversation about the hedge funds, what they are, who they are, why they have an advantage, how their advantage is even made more or worse by the lack of supply of single family homes, which of course then therefore with the supply and demand has pushed up housing prices in a lot of markets all over the country, not just here in South Florida. And so would-be home buyers find that they're being outbid, not just by other home seekers, but by hedge funds, thereby becoming landlords. And so I've been saying this now for quite some time, and I'm talking about not weeks and months, but literally a couple years, that real estate investing is no longer the sole playing field of you and I, mom and pop sized investors. And so as a result, we now have to kind of up our game, and up our game we will, right? I want to say hi to Cindy, who just joined us on our Facebook Live, to Susanna, welcome there, and a couple others that are there. So I invite you, Al-M and Sheila, all of you that are joining us on the Facebook Live page. The neat thing about that is that they can comment, say hi, even ask questions along the way. We've been talking actually about opening up Fridays as an open Q&A, and I'd love to know your thoughts about that. And if you're interested in having the ability to call in Q&A, we got so much stuff to cover. As you know, I often run out of time before I run out of things to talk about. But we could open the phone lines a little bit and answer some of your questions. and we do that in our workshops, and that's why, for example, tonight at 7:30 we've got our first time home buyers workshop. Next week on Tuesday we're going to be having our credit workshop, where we'll dive deep into the whole conversation about credit, what, where, why, how, and what you can do about it. We've been doing some really fantastic things, helping folks with credit, because that's one of the steps on the ladder to home ownership. So between putting together the information about the down payment assistance, multiple information there. Susanna says, yes, voting for the Friday Q&A call-in session. And I like all the little emojis there too. So very enthusiastic there. And then we talk about the different financing programs that allow for lower down payments, which will help a lot of people. And you match that with the down payment assistance. So we can do this with almost no money. Sometimes there's some costs that are involved, but sometimes it's as little as $500 to $1,000. And when you think about that you can get into a home and own it for as little as $500 to $1,000, compared to a minimum of first, last, and security just to rent. There's a clear-cut advantage, and not to mention the fact that you've got tax advantages, you've got equity advantages, both in the equity buildup that you're going to create by paying down the mortgage, in the equity that you'll gain through the appreciation. So we could just go on and on about that. So we then just a quick recap there. We were talking about that there's been a large number of investors, and the percentage, which historically has been somewhere between 60 and 70% homeowners, and 40 to 30% non-owner occupant landlords. And all of this is very relevant. Remember, when we were talking about the moratoriums, we were talking about who's affected, the number of people who are affected, while there's a lot more, or many more, tenants out there than there are landlords, because some landlords have multiple properties, and that's why they can be more adversely affected. So we talked about that the vast majority right now of investors have been mom and pop landlords up until about, I would say, 2008. And when we had that big market crash, and millions of people were literally foreclosed upon, and the big hedge funds saw that opportunity, and it was kind of a interesting evolution to watch, because at first, and traditionally, these hedge funds only wanted to buy commercial properties, a large building, whether it be a large office building, a large, commercial property, or even a, multi-unit residential property, because it's one roof, one address, one manager, you can staff it much easier all in one place. On the other hand, they have, managing 1,000 roofs, 1,000 separate roofs. It's better. One roof, 1,000 units, or 1,000 roofs, 1,000 units, 1,000 addresses. But lo and behold, here we are, a number of years later, and they have mastered that issue now. And so the whole property management thing has really, gone to another level. And it's kind of neat, because we were on the front edge, the cutting edge of the whole landlord business back in the 90s, when we were starting to automate the landlording, and there was a clear-cut difference. Now a lot of that has come up. We had to self-design and program our own software back then to be able to collect online, give reports online, and do all those all the things that today have become much more accessible. And by the way, make landlording much more enjoyable, much more profitable. And I will say that it's just it makes it more accessible. Yet the competition now has also risen. So we talked a little bit about a quote from David Dworkin, the CEO of the National Housing Conference, and he was commenting that nationally the cash offers that typically used to make up about 1/4 of the market now is over 1/3 of the market. In other words, from 25% to over 33%, which is a pretty significant jump in the number of cash buyers. Basically, 1 in 3 offers is a cash buyer. I remember back in 2008 when the market first had its, when it initially tanked, and then the first of the cash buyers came in, and whenever we showed a cash buyer offer, it stood up and was outstanding. Today, when you say I've got a cash offer, it's kind of like, so. And in fact, in today's market, it's so competitive that people are not even allowing the mortgage contingency if you want to be competitive. So, Susanna, the answer is yes. If you text the letters DPA to 561-861-2366, and so you'll get a response, and then the link will follow a little bit later. But I'll double check, and I'll look for you on the list and make sure. Alternatively, you can also go to our website at automaticlandlord.com and send us a message through there that we'll also know there. So again, competition from investment entities is a symptom of a much bigger problem in the housing market. The reason we have this crisis right now goes beyond the investors, and so we also started talking about the number of properties being built, which for literally a decade, from 2008 to 2018, the returning buyers were outpacing the number of units being built. And so if investors are holding on to more properties and not selling them, even homeowners, in the last year or two, I'll even say that a lot of sellers decided to wait a little bit for a couple of different reasons. Some say, well, I'm going to get more next year. Why don't I just wait a little bit longer? No rush. Number two is that when they started going out there to look what they could buy with what they were going to get, there wasn't, the property values had gone up, and therefore they basically retrenched and said, you know what, it's not worth me selling that unless I needed to relocate. It wasn't about upsizing, downsizing, and so forth because of, again, it boils down to supply and demand. But the reasons that we have the supply and demand imbalance are many, from the demographics to the supply, to the financing that's available, to the increasing number of eligible buyers. And of course, we talked about this whole thing about remote working. Anyway, that leads us to another article about home builder sentiment. Now, this is interesting, right? You would think that home builder sentiment would have to be very high right now, knowing that whatever they build, there's a lot of demand, right? Well, the answer is not so obvious, and I'm going to tell you the answer when we come back. We're going to go ahead and take a quick break. Here are a few words from our sponsors. You're listening to the Real Estate Show, Tools, Tips, and Techniques. We got more tips and techniques for you to help be successful buying your house, even in this market right now. So don't touch that dial. My name is Eric Willner. I'm your host, and I'll be right back. That was loud. This is an opportunity to share with you photos, videos. Donnie, how are you doing today? Upcoming events and a lot more information on a regular basis on our Facebook. Make sure that the number is correct, but I will double check. And plus I'll have a note there now on my on the Facebook. I'll make sure that that you're interested in those 3 items. So check us out. There's even more. See more. Can you? Okay, absolutely, I can help you. Happy to do so also. Cindy, how are you? We got California. Susanna, what part of the country are you in? Back to today's show. And welcome back. For those of you just joining us here on the Real Estate Show, my name is Eric Willner, and I'm your host. And we are live here 5 days a week with brand new, fresh shows each and every single day of the year, Monday through Friday. In fact, not only Monday through Friday, those are all the new live shows. We have our Sunday show, Sunday at 9 p.m. back to back. We broadcast each one of our daily shows. So since we tend to start the week off with our Mondays on a mission, we'll pick a subject, we'll pick a topic, and then kind of weave in and out of it from the definitions and talking about the whole concept of what we're talking about, to Tuesdays getting it to the point where now we're talking about specific tools that we're using in the marketplace to help us with that concept or that strategy or that technique. We'll talk about the various techniques that we're really doing in being active in today's market. This is not textbook. This is not theory. This is real life. And then Wednesdays, we go to our midweek report, which we'll have tomorrow again. And we'll be talking about what's going on in the news in relation to this very topic. And so whether it was last week talking about land, whether it was the week before talking about the moratoriums, and the moratorium seems to keep weaving itself. It's a hot topic right now, and everybody's on the edge of looking at now. They've kind of separated. Before it was the landlord eviction moratorium was tied with the foreclosure, and now, oddly enough, and this is kind of like along the lines that I said, the responsibility is much more heavy on the landlord, because remember, he's pledged an asset as collateral in the mortgage. So if he somehow can't perform, they're going to take the asset. In a tenant's situation, the worst that they can lose, besides the occupancy, and the landlord and the tenant would lose it in either case. But while the landlord loses an asset, the tenant may lose at most 1 month security. And for tenants who haven't paid in 18 months now, it could easily amount to 18 months. If you think about the 1% rule, typically rent is about 1% of the market value. The landlord could lose 18% just by the tenant going away. And yes, they can sue, and many for that amount of money will. Yes, they can go after a tenant, but if the tenant is in fact broke, then it's going to be a loss. And the landlord also has a double expense, paying his mortgage and going after the lack of the rent. So that's why you see I often talk about the heavier burden borne by the landlord, which is why it's good that they gain equity in over time through the pay down of the mortgage. It's good that they get appreciation in there because they are much more committed. They are much more even at risk, but the rewards also can be very good. So interestingly, I was talking about how we have a shortage of supply, and we have, for about 10 years, from 2008 to 2018, there was virtually no construction going on in the residential market. And then, of course, it started to really pick up 17, 18, 19. And the last 2 years, we've seen much more building, and the home builder sentiment has been up. Home builder stock prices have been going up, as well as the values of the properties. But today, I saw an article that said home builder sentiment falls to the lowest level in over a year as buyers face sticker shock. So they would love to keep building, but with the pressure of the construction costs, with the pressure of the labor costs, land costs, and everything else going up, it's hard for them to build something that's really affordable nowadays. And I've been saying, again, for probably, I'm going to say close to 3 years, that affordability is becoming a bigger and bigger, and now an even bigger issue, that it's not just the inventory, it's the affordability that matters. And so the single family home builders, their sentiment, there's an index, a home builders index, home builder sentiment index, dropped 5 points to 75 in August on the National Association of Home Builders Wells Fargo Housing Market Index. Sales expectations in the next 6 months were unchanged, though. So think about this. And remember when I said that this slowdown is in fact good news? And I'm going to tell you that there's actually some good news in this. What looks like a warning sign for the market could actually be a healthy slowdown in the market to maintain sustainability of the market and will contribute to the affordability issue. So, home sales expectations in the next 6 months were unchanged at 81. So, interesting, other part of this article, lumber is down 72.5% on its intraday peak of $1,711 back in May. So we're looking at that. I'm looking at the lumber charts, and it peaked back in May, and now it's at about 457. So almost half off, 50% off of the peak, and a little bit less than where it was at the beginning of the year. So the price of lumber has fallen sharply in the last few months, but apparently has not been enough to take the pressure off of home builders. Sentiment amongst single family home builders dropped five points. I mentioned that. Anything above 50 is considered positive, by the way. So remember, we're at 75, but it is the lowest reading we've had since July of 2020, literally a year ago, where the index stood at 78 last August. So of the index's three components of that, current sales conditions fell 5 points to 81. Traffic of prospective buyers fell 5 points to 60. And sales expectations the next 6 months was unchanged at 81. So think about it. Current sales lower, no inventory, expensive. Traffic off a little bit. Expectation for sales the same full speed ahead, a little bit more moderate, and that's good. So builders are contending with a continuing rising costs of materials as well as skilled labor, and that is pushing the price of newly built homes even higher and clearly affecting demand. And what was also very interesting, a couple of months back, if you remember, we were talking about that existing homes, typically new homes, carry a premium. So if the market value of the existing home was 100, a brand new home would be 105, maybe 110, because it was brand new, still has that new car smell, new home smell, and it's customized, never been used to your taste. Recently, we saw that existing homes were selling at a premium and as much as new homes. So we're going to see how it turns out if we'll go back to the new home premium, regular homes, and a very interesting dynamic there. Anyway, that's it for today's show. We got a whole bunch of articles right in this vein. Remember, if you want to come to the tonight, text DPA, the letters DPA, to 561-861-2366. Otherwise, I'll see you same place, same time tomorrow right here for our midweek report on this whole topic of buying homes in today's market. So until then, this is your host, Eric Willner, signing off and saying, drive safe, wash those hands, and make it a great day. Bye-bye.